Have you heard that Palm Springs property prices are crashing? Think again. While this myth circulates, the data reveals a really different reality. The median price just hit $710,000, marking the fifth straight month of increases. For buyers, that means preparation is the key, and for sellers, opportunity awaits. Hi, Neal here, your Living in Palm Springs realtor, and today I'm exposing the 3 most damaging myths about our local market that could cost you thousands if you believe them. I'll break down what's really happening using the latest information, giving you actionable insights whether you're buying your desert dream home or selling to capture maximum value. You've probably heard the headlines. Real estate markets are cooling nationwide. The housing bubble is about to burst. Price crashes are coming. These dramatic claims have many people worried about the Palm Springs market specifically. But are prices really falling here in our desert paradise? Let's look at what actually is happening here in the Coachella Valley real estate market this April 2025. When we examine the raw data, our current inventory sits at 3,667 units across the entire Coachella Valley. Now that represents a substantial jump from this time last year when we had 2,396 units. Many assume this inventory increase should be driving prices downward, like a seesaw where added supply naturally pushes the prices down. Yet the market isn't following this expected pattern. Despite the inventory surge, the median price for single-family homes throughout the Coachella Valley has steadily increased for the past 5 consecutive months. As of April 2025, that figure stands at $710,000, which is $11,000 higher than where we were at this time last year. Now, this contradicts the standard narrative about crashing markets and that many national publications are pushing. Looking deeper into our backyard, city-by-city performance here reveals important nuances. Indian Wells, in particular, has experienced remarkable appreciation, with average prices climbing 18.6% year over year to reach over $2.2 million. The luxury market remains exceptionally strong, with several high-end sales driving up those figures. However, not every city follows this trajectory. Palm Springs proper has experienced a modest 4.2% decline in average prices compared to last April. Now, this creates a micro market opportunity where savvy buyers might find relative values that weren't available during the frenzied market just a few years back. The month of sales ratio, which measures how long it would take to sell all current inventory at the present sales pace, has reached 6.0 months. That's across the entire Coachella Valley, traditionally signaling a shift towards a buyer's market. Yet, interestingly, this has not triggered widespread price reductions like many people have predicted. Sales volume shows remarkable stability at 645 home sales during the past 3 months. That's virtually identical to the 643 sales during the same time last year. This consistency suggests market balance rather than any collapse scenario. What we're witnessing is a return to normal market conditions. The pandemic created extraordinary circumstances, record low interest rates, and an urban exodus, and remote work flexibility that specifically benefited resort destinations like here in Palm Springs. Those extreme conditions couldn't last forever, and now we're seeing a healthy normalization. The current state offers advantages for both buyers and sellers. Buyers have more choices and time to make decisions without the pressure of bidding wars. Sellers with properly priced homes are still finding buyers, just not overnight and not always with multiple offers. Think of it as the market taking a deep breath after running a marathon. The pace is slowed to something more sustainable, but we're still moving forward. This isn't a crash, it's a recalibration reflecting the broader economic reality. This market recalibration has created a fascinating shift in negotiating dynamics. After years where sellers held all the leverage here in the Palm Springs area, Palm Springs buyers are now gaining substantial power at the negotiating table. The evidence speaks for itself. Purchasers are securing discounts up to $17,500 on $700,000 homes throughout strategic approaches that simply weren't possible during the pandemic era. This marks a significant departure from the conditions we've grown accustomed to in recent years. The days when sellers could name their price and expect multiple offers within days are just fading into memory. The pendulum has swung toward balance, with inventory surging 53% year over year across the entire Coachella Valley. This flood of available properties has fundamentally altered the market psychology for both buyers and sellers. Properties now sit for an average of 48 days before selling, varying significantly by location. Cathedral City homes typically move in about 41 days, while Desert Hot Springs homes linger for 59 days. These extended timelines give buyers breathing room to consider the options and the leverage negotiating terms. The technical definition of a buyer's market occurs when the month of sales ratio crosses the 6.0 months threshold, measuring how long it would take to sell all the current inventory at the present sales pace. We've officially crossed that line valley-wide, creating conditions that favor buyers for the first time in many years. This translates directly to advantages at the negotiating table. Consider one family who recently purchased in Palm Desert. After identifying a property that had sat on the market for 47 days, they leveraged the situation to negotiate a $17,500 reduction from the asking price, plus they got some seller concessions for closing costs. A full 36% of the homes in our area are experiencing downward price adjustments. This happens because sellers continue pricing properties based on peak market conditions rather than our current market realities. When a home sits for weeks with limited showings, a price reduction follows. That creates opportunities for observant buyers. The mortgage rate environment has provided a small tailwind as well. With rates under 7% for a 30-year fixed mortgage, we're seeing improvements from the 7+ rates that we had earlier this year. Even small decreases translate to meaningful improvements in purchasing power when combined with increased inventory and longer market times. Properties listed for more than 30 days represent strong negotiating opportunities. Sellers of these homes often experience mounting pressure, especially if they've already purchased another property or they need to relocate. This anxiety creates leverage that savvy buyers can utilize for negotiating price. They can also negotiate contingencies, closing timelines, and included items. The average discount for a single-family home has reached 4.1% in Palm Springs. That's the highest in the Coachella Valley. For a $700,000 property, that's potential savings of $28,700. These discounts require informed strategy and confident negotiation. Buyers who approach with knowledge of recent comparable sales and understanding of the property's history can achieve results that would have been unthinkable during the height of the pandemic market. The pendulum of market power has swung decisively towards buyers, but beneath this apparent trend lies an economic reality that few are discussing. What happens when millions of homeowners with sub-4% mortgages simply refuse to sell? The Fed cut rates twice this year, and our local population continues its steady climb while new housing remains constrained. After witnessing newfound buyer leverage, it's time to examine if the seller's reign is truly over. Like a tide that appears to be fully out, market forces already contain the seeds of their reversal. While recent sales discounts and extended listing times favor buyers today, several underlying factors suggest this advantage does have an expiration date. The Coachella Valley population is projected to grow by 15% by 2030. That creates sustained housing demand in an area where geographic constraints and development regulations are limiting new inventory growth. This demographic expansion will eventually collide with our limited supply of new homes. When population grows faster than the housing that's available, the math becomes simple: more buyers competing for relatively fewer properties. The current balance favoring negotiations could then shift dramatically when the population growth does accelerate. The lock-in effect further restrains inventory growth as homeowners with pandemic-era mortgages between 2.5% and 4% face powerful financial disincentives to sell. A homeowner with a $700,000 mortgage at 3% would see their monthly payments increase by approximately $1,650 at today's rates, keeping many properties off the market. The mortgage rate environment shows signs of improvement that could stimulate demand. The spread between the 10-year Treasury yield and the 30-year mortgage rates has declined 2.5%, suggesting potential improvements in borrowing costs even before Federal Reserve action. Analysts increasingly expect Fed rate cuts in both June and September. Now, these anticipated cuts would improve affordability and also stimulate buyer activity. March data revealed mortgage purchase applications increasing for 6 consecutive weeks, despite current rates remaining above pandemic-era lows, indicating pent-up demand waiting for even modest rate improvements. Historical patterns provide additional perspective. Here in the Coachella Valley, periods where buyers hold negotiating advantages typically last between 12 and 18 months before market forces rebalance, a pattern that we're consistently seeing through multiple cycles starting since the early 2000s. The increasing months of sales ratio doesn't tell the complete story. This metric measures the current balance between supply and demand, but does not account for demographic shifts. It doesn't account for interest rate changes or homeowner reluctance to list their properties, factors that could rapidly shrink available inventory once rates decline. Market projections suggest a transition back toward a seller's market as early as late 2025 or early in 2026, aligning with population growth and Federal Reserve actions and also historical market cycles here in our area. For potential buyers considering a Palm Springs area purchase, this analysis suggests strategic timing could be crucial. The current window of opportunity may prove temporary, with those waiting for further price declines potentially facing renewed competition if these projections do materialize. Have you experienced these market shifts firsthand? If you have, share your story in the comments below. As we've explored the April 2025 market, it's clear that we're experiencing a moment in the Coachella Valley that's unusual. The increased inventory and rising months of sales have created strategic opportunities for both sides of the transactions. Buyers now have more room to negotiate, while sellers who price competitively can still attract serious interest. Local expertise does matter deeply. Indian Wells' 18.6% price jump versus Palm Springs' 4.2% decrease shows how dramatically neighborhoods differ. Remember, real estate is cyclical and hyperlocal, and the current market presents different opportunities depending on which side of the transaction you're on. Buying or selling can be stressful. If you're curious about specific areas or neighborhoods here in the Coachella Valley, let's schedule a quick Zoom call to discuss your needs. It's free and there's no obligation. Just click on the link in the description below. I'd love to speak with you. Now, watch this next video all about living here in Palm Springs.